All right, hey everyone. Today we're going deep, diving into UK tax and business updates for 2024. You're in the right place if you want to make some savvy financial moves this year because we've got a ton of info straight from the pros at MANCO Accountants. We've got articles, podcast announcements, the works.
Yeah, they're always on top of everything.
Exactly. And it's a lot to unpack. Things have been shifting big time. We're talking about the super deduction going away and this full expensing thing appearing, plus all the essential updates on corporation tax, national insurance, even some clever inheritance tax strategies. Are you ready to decode all of this with me?
Absolutely. Let's break down these changes.
Okay, first up, super deduction sunset. MANCO put out this article, and it says the super deduction is gone, kaput, for plant and machinery investments. Remember that 130% tax break? It almost felt like a dream.
Well, it was always meant to be temporary. They introduced it back in 2021 to get businesses investing again after the pandemic hit. It basically let companies deduct £130,000 from their taxable profits for every $100,000 they spent on qualifying equipment.
Okay, so hold on. Is this full expensing just a rebranded super deduction, or is there something we need to watch out for?
It's definitely not just a name change. Full expensing also lets businesses deduct 100% of the cost of qualifying plant and machinery, right off their profits, in the same year they make the investment. But the key difference here is that extra 30% deduction the super deduction had. Gone. Full expensing makes things more stable, more predictable, but it won't have that same, immediate impact on cash flow.
Ah, I see. It's a trade-off then. If you're running a business, this changes the game for how you think about buying equipment.
Yeah, exactly. The super deduction pushed everyone to move quickly. Now, with full expensing, you can plan out your big investments over the long term with a lot more certainty.
That makes sense, like shifting from a sprint to a marathon, thinking about the long game.
Exactly.
Okay, let's move on to corporation tax. MA and CO have a breakdown of the different rates for 2024, and it's more complicated than just a single number. There's the small profits rate, the main rate, and then this marginal relief. Can you walk us through this?
Sure. The small profits rate, it's at 19%, applies to companies with profits up to £50,000. Then we have the main rate, 25%. That kicks in for profits over £250,000.
So if your company is somewhere between those numbers, is that when marginal relief comes into play?
You got it. It's specifically designed for those in-between businesses. Marginal relief makes sure companies don't get slapped with the full 25% the second they hit £50,001 in profit. There's a sliding scale that reduces the rate as your profits get closer to the £250,000 threshold.
Okay, trying to picture how this works in real life. Can you give us an example of marginal relief in action?
Say a company makes £150,000 in profit. Without marginal relief, they're looking at the main rate, meaning a corporation tax bill of £37,500. But marginal relief comes in and lowers the rate, so they end up paying less tax overall.
Oh, that's good to know. It's like a safety net as businesses grow, making it easier to handle moving into a higher profit bracket.
Exactly.
Speaking of relief, let's not forget about the annual investment allowance, or AIA. I see it's still going strong.
Oh, for sure. AIA is a great tool. It lets businesses deduct the full value of qualifying capital expenditure from their profits before they calculate their tax bill. And the current cap is a pretty generous £1 million.
Wow, 1 million. I doubt most businesses hit that every year. But can you give us an idea of what they can actually deduct under AIA?
Think of the essential things your business needs to run and grow. Computers, equipment for your office, vans, lorries, even certain fixtures in your building. It's quite a wide range, though there are some things you can't deduct, like cars or things you lease out.
So, like if you're getting a brand new delivery van, AIA can help you out.
It might, but it's really important to time those investments strategically. The AIA works on a use-it-or-lose-it basis every financial year.
Ah, so you can't save up those allowances for a rainy day.
Right. And another important thing to remember is how AIA works with other capital allowances. Let's say you're investing in something that qualifies for both AIA and full expensing. You got to figure out which route gives you the most benefit.
Sounds like it's time to chat with your accountant, right? They can help you navigate all of those fine details and make sure you're getting all the deductions you can.
Definitely. They're the best resource for these kinds of decisions.
All right, we've talked about what's in it for businesses, but now let's talk about something that affects everyone. National insurance contributions. I know they can feel a bit like a drag, but they do pay for important stuff like the state pension.
That's right. National insurance contributions, or NICs, are a big part of how the UK's social safety net works. Whether you're employed, self-employed, or an employer, you need to know what you're responsible for. The amount you'll pay depends on your earnings and your classification.
And there are all those different classes of NICs, aren't there? Class 1, Class 2, it can get pretty confusing. Can you break those down for us?
Sure. There are four main classes. Class 1 is for employees and employers. Class 2 is for self-employed folks, and it's a flat weekly rate, no matter how much you earn. Class 3 is for voluntary contributions. You can use it to fill gaps in your national insurance record. And finally, Class 4, that one's also for the self-employed, and it's based on your profits.
Okay, so first you need to know which class you fall under. And those thresholds and allowances for each class, they're always changing, right? Is there anything specific we should know about for this tax year?
Absolutely. For those who are employed, you start paying Class 1 NICs once your earnings go over the primary threshold. That's currently £12,570, and just so you know, that's the same as the personal allowance for income tax.
So you begin paying both NICs and income tax at the same income level. That's interesting. What about the actual rates?
Until your earnings hit the upper earnings limit, which is right now £50,270, you're paying 12% on anything you earn above that primary threshold. Anything you make above that upper limit gets taxed at a lower rate of 2%.
Got it. So what about employers? What are they responsible for?
Employers also contribute to Class 1 NICs. They start paying once an employee's earnings go above that same primary threshold, the £12,570 we talked about. Their contribution rate is 13.8% on those earnings.
Okay, so it's a shared responsibility there. Now, for our self-employed listeners, what about those Class 2 and Class 4 NICs?
All right, so for those who are self-employed, Class 2 NICs are set at a flat weekly rate of £3.45, but only if your profits are above the small profits threshold, which is £6,725 per year. Class 4 NICs kick in once your profits are more than the lower profits limit, which is that same £12,570 we keep seeing, just like the personal allowance. The rate is 9% on profits between that lower profits limit and the upper profits limit, which, for now, is £50,270.
That £12,570 figure keeps popping up. Is that on purpose?
Yes, it is. The government lined up a few of these key thresholds to simplify things. It means that a lot of people start paying income tax, Class 1 NICs, and Class 4 NICs all at the same income level.
That's helpful. But like always, I'm sure there are always exceptions and special cases. I bet this is when having a good accountant is really worth it.
Oh, absolutely. They can make sure you're handling all of this correctly.
Okay, we've covered how we all contribute through national insurance. But of course, the tax man doesn't stop there. Let's talk about income tax, the one we can't avoid.
Yes, income tax is a big piece of the puzzle, and MA and CO have this helpful post about the thresholds and rates for the current tax year, which, as we know, are always subject to change.
Right, gotta stay up to date. I see the personal allowance is still at £12,570. That's how much we can earn before we have to pay income tax.
Exactly. But once you're earning more than that allowance, things get a bit trickier with the income tax bands.
Right, because the different parts of our income are taxed at different rates.
That's it. In England, Wales, and Northern Ireland, we have what's called the basic rate. It's 20% for earnings between £12,571 and £50,270. Then it bumps up to the higher rate of 40% for anything you earn between £50,271 and £125,140. And finally, we have the additional rate of 45% for those earning above £125,140.
So the more you earn, the higher the tax rate on parts of your income. Makes sense.
However, there's one important detail. Once your income goes over £100,000, your personal allowance starts shrinking.
Wait, so you actually start losing that tax-free allowance as you earn more?
Essentially, yes. For every £2 you earn over £100,000, your personal allowance goes down by £1. This continues until you reach an income of £125,140, and at that point, your personal allowance disappears completely.
Wow, so for anyone earning between £100,000 and £125,140, that's like a hidden tax bill.
It is. That tapering can really impact your overall tax bill, so it's important to be aware of it.
Okay, let's shift gears a bit and talk about another part of financial planning. Inheritance tax. The tax man gets you even after you're gone, right?
It's true. But MA and CO have this interesting article about using something called discretionary trusts for inheritance tax planning. They sound pretty complicated.
They do. So how do they actually work?
Well, with a discretionary trust, you're putting assets under the control of trustees, and they then have the power to distribute those assets to your beneficiaries based on your wishes.
So it's different from a will where everything is set in stone. There's more flexibility.
Exactly. The trustees get to decide how and when the incoming capital are distributed, and that can be a real advantage for a few reasons. One of the biggest is that it can help you minimize inheritance tax.
Okay, now I'm really interested. How do these trusts help with inheritance tax.
When you move assets into a discretionary trust, you're essentially taking them out of your estate as far as inheritance tax is concerned. This can significantly lower the value of your estate and, as a result, reduce the potential inheritance tax that would be due.
Ah, I see. So it's a clever way to potentially lessen the tax burden for those who inherit from you. But who exactly are these trustees and how do you choose them?
As the person setting up the trust, you get to choose the trustees. It could be family members, friends, even professionals like solicitors. They have a legal obligation to manage the trust assets responsibly, always acting in the best interests of the beneficiaries you've chosen.
So there's a lot of trust involved, literally. Besides potentially saving on inheritance tax, are there any other benefits to going this route?
Absolutely. Discretionary trusts also offer asset protection. That means the assets in the trust are shielded from things like creditors or any financial difficulties the beneficiaries might have. Plus, it gives trustees the flexibility to change how distributions are made as the beneficiaries' needs change over time.
So it's not just about reducing taxes, it's also about making sure the assets are protected and used wisely for your loved ones. That's really powerful.
It is. Now let's get into the last topic for this part of the deep dive, the Autumn Budget 2024. MA and CO have an analysis of the key points, and it's full of info that will definitely shape the next financial year.
Oh, yeah, the autumn budget always gets people talking. What were the big takeaways this time?
The budget was really focused on three main things: helping people with the cost of living, supporting businesses and public services, and making sure the government manages its spending and debt properly.
Okay, they're covering all the bases. Let's break down each of those areas. Starting with cost of living support, what specific measures did they announce?
Well, they acknowledge that people are still struggling with prices going up, and they promise to provide targeted support, particularly for the people who are being hit the hardest. This includes putting more money into programs that help with energy bills and taking steps to help low-income households with the cost of essential things.
That's good to hear. Now, what about supporting businesses and public services? Were there any big announcements there?
The goal was to create a better environment for businesses to grow and invest. They talked about simplifying regulations, providing tax breaks for innovation, and encouraging more investment in key areas like technology and green energy.
Sounds like they're trying to set up a more competitive and sustainable economy. How about public services? What support are they getting?
They know that essential services are under pressure, so they announced they're increasing funding for the NHS and education. Hopefully this means shorter wait times for healthcare, better facilities, and more resources for schools.
That's definitely good news, especially with all the challenges those sectors have been facing. Now let's wrap up with managing public finances. What's the plan there?
The government is focused on being responsible with its spending. They want to support the economy, but they also want to control debt. They've outlined plans to reduce the national debt by cutting spending in some areas and raising taxes where they think it's necessary.
So they're trying to find that balance between encouraging growth and keeping the budget under control.
It's a delicate balancing act for sure.
Wow. There's a lot to take in. We've covered so much already, from capital allowances and corporation tax to national insurance, income tax, even inheritance tax planning, and the highlights from the autumn budget. You've been an amazing guide through all this.
Happy to help break it down.
It's so clear that the UK tax and business world is constantly changing. Staying informed is essential for everyone.
Absolutely. Knowledge is power, especially when it comes to your finances.
All right, before we finish up this part of our deep dive, I want to leave you with something to think about. With everything we've covered, how are you planning to adapt your own financial strategy this year?
That's a great question, right? It's about taking what we've learned and putting it into action.
Exactly. This isn't just about passively listening. It's about using what we've learned to make some real decisions.
For people running businesses, that shift from the super deduction to full expensing, that could mean changing their investment plans significantly. And for everyone, understanding the details of corporation tax, especially marginal relief, is crucial if they're dealing with different profit levels.
You're right. And it's not just for businesses. Everyone needs to be on top of those changes to national insurance. Those thresholds and rates can sneak up on you.
For sure. Whether you're employed, self-employed, or an employer, you've got to understand what you're responsible for when it comes to NICs.
And don't forget about that personal allowance taper for income tax. That's a detail everyone needs to factor into their plans, especially if they're earning over £100,000.
It's subtle, but it can make a big difference.
Okay, so there's a lot to think about on the personal finance side, too. I've got to say, I'm really intrigued by those discretionary trusts. They seem like a really smart way to plan for the future, not just about paying less tax, but also about making sure your assets are protected and used wisely. It's about legacy.
That's a great way to put it. They give you a level of control and flexibility that can be invaluable.
And then there's the autumn budget, always changing things up. It seems like the government is really trying to strike that balance, helping people where they need it, creating a strong economy, and managing the national debt.
It's a tough juggling act, that's for sure.
It makes you think, doesn't it? There's always something new to learn and consider when it comes to our money.
That's what keeps it interesting.
Absolutely. And we don't have to figure this all out on our own. Experts like you are so helpful in breaking down these complicated topics and making them understandable.
I'm always happy to share what I know and help people make sense of it all.
Well, we're going to continue this conversation in part 2 of this deep dive. But for now, what stands out to you as the most important thing we've learned?
What really fascinates me is how those short-term incentives, like switching from the super deduction to full expensing, connect to long-term planning strategies, things like using discretionary trusts. Both have a big impact on the financial landscape.
That's a great point. It's about finding that balance between taking advantage of opportunities that come up and building a solid foundation for the future.
Exactly. The autumn budget shows that balance too, trying to deal with current problems while also setting a course for the economy to be stable over the long term.
Okay, so on that note, we'll wrap up part 1. We'll be back soon to continue this deep dive. Until then, keep learning and keep your money safe.
It really is like building a house. You need a good, solid foundation, but you also need the right tools if you want to create something that lasts.
I love that analogy. Okay, we talked about how businesses need to be ready to adjust their investment strategies with all these changes. But what about everyone else, the people who aren't running businesses? Are there any takeaways they can apply to their own personal finances?
Definitely. Remember those national insurance changes we discussed? It's a good idea to double-check, are you in the right NIC class for your situation? And do you really understand those thresholds? People often overlook this, but even a small change in your contributions can really add up over time.
You're right, those little details matter. And that personal allowance taper, it's almost like a trap for people who aren't paying close attention.
It can be, yeah, especially if your income goes up and down. It's smart to do the math and figure out how going over that 100,000 pound mark could affect your taxes.
It reminds us that we need to be thinking ahead, being proactive with our money, not just reacting when things happen.
Exactly. Don't wait until you get your tax bill to start planning.
Okay, so planning ahead is key. I have to admit, those discretionary trusts have really got me thinking. They seem so useful, not just for maybe lowering inheritance tax, but for managing wealth for future generations.
They can be a great tool, but they're not the right fit for everyone. It's really important to think about your own situation and what you're trying to achieve. For instance, if you have young children or grandchildren, a discretionary trust could be a way to protect their inheritance until they're older and can handle it responsibly.
That makes a lot of sense. It's like adding another layer of protection and control.
Right. And discretionary trust can also be helpful if you have beneficiaries who have special needs or situations that require a more personalized approach.
So it's about creating a customized plan for your legacy, making sure the assets are used in a way that truly reflects your wishes.
You've got it.
Okay, so we've seen how these tax updates and planning strategies affect individuals. But let's zoom out a bit. What about the big picture? The autumn budget is trying to steer the economy in a certain direction, right? What messages are they sending, and what should we be paying attention to?
You're right. The autumn budget is more than just a bunch of numbers. It tells us what the government's priorities are. It's like a map for where they want to take things. One big message they're sending is that they're focused on balancing what we need right now with making things sustainable for the long term.
So they're dealing with things like the cost of living crisis while also looking ahead, investing in things like green energy and innovation.
Exactly. They're trying to walk that line between addressing urgent problems and investing in the future.
And what about those plans to lower the national debt? Cutting spending and increasing taxes, those aren't usually very popular moves. How do you think those measures will affect everyday people and businesses?
Well, that's the big question, isn't it? The impact is probably going to be different for everyone, depending on their situation and the specifics of those cuts and increases. It's something we'll all need to keep an eye on as things unfold.
Definitely something to watch. It seems like navigating the financial world these days requires knowledge, awareness, and a good dose of flexibility.
I totally agree. It's about being informed, proactive, and maybe most importantly, knowing when to ask for expert help.
And that's where professionals like you come in, right? You can help people and businesses understand these complicated rules and regulations.
That's what we're here for, to provide some clarity, guidance, and support as people navigate these sometimes turbulent financial waters.
Okay, so we've gone over the key takeaways from these MA and CO resources. What I find really interesting is how everything seems to be connected. Topics that might seem separate, like capital allowances and inheritance tax, are actually all part of the same bigger picture.
You've hit on a really important point. Whether you're running a business and making investment decisions, or you're just an individual planning for your future, you have to remember that financial decisions don't happen in a vacuum. They all affect each other.
It's like a chain reaction. One decision can set off a whole series of consequences, both good and bad.
That's exactly why a holistic approach to financial planning is so important. You need to understand how the different pieces fit together and make choices that line up with your overall goals.
That makes a lot of sense. So, for our listeners who are feeling a bit overwhelmed with all this information, what's the one piece of advice you would give them?
I would say don't panic. The key is to break it down into smaller steps. Start by figuring out which areas are most important for your situation and focus on those first.
Okay, so prioritize and don't try to do everything at once. What would be a good starting point?
A good place to begin is to take a look at your current financial plan. What's your income and your expenses? What assets and debts do you have? And then think about your goals. What are you trying to achieve? Are you saving for retirement, maybe planning for your children's education, or are you trying to grow your business?
Once you know where you stand and where you want to go, you can start figuring out the strategies and resources that will help you get there.
Exactly. And don't be afraid to ask for help along the way. There are tons of resources out there. Financial advisors, accountants, even online tools and guides.
Right. There's nothing wrong with getting expert advice. In fact, it's often the smartest thing you can do.
It really is. Trying to figure out the world of finance on your own can be super overwhelming and could end up costing you more in the long run.
So we've talked about the big picture and the importance of a holistic approach, but I want to focus on a specific area that I know a lot of our listeners are curious about: inheritance tax planning.
That's a topic a lot of people put off, but it's really important to address it sooner rather than later.
I agree. Nobody likes to think about their own mortality, but planning for the future is a way of showing love and responsibility, not just for yourself, but for your loved ones.
Couldn't have said it better myself. And with inheritance tax rates being what they are, it's essential to think about strategies that can minimize that potential burden on your heirs.
Those rates can be a big deal. So, aside from those discretionary trusts we discussed, are there other options for people who are looking to reduce their potential inheritance tax?
There are a few other things you can do. One popular strategy is giving gifts while you're still alive.
Gives? You mean like birthday and Christmas presents?
Well, those count, but I'm talking about more substantial gifts, like a large sum of money or giving away some of your assets.
Oh, I see. So by giving away some of your wealth now, you're basically making your estate smaller, which could reduce the inheritance tax bill later.
That's the idea. And there are certain rules that let you make gifts without triggering immediate inheritance tax. For example, you can give away up to £3,000 each tax year without any tax consequences. And you can make unlimited small gifts of up to £250 per person each year.
Oh, that's interesting. So even small gifts, if you give them regularly, can add up over time and help chip away at that potential tax bill.
It's all about strategy and thinking long term.
Okay, gifts are one strategy. What else is out there?
Another option is to invest in assets that qualify for inheritance tax relief.
Oh, like what kinds of assets?
Certain things like business relief shares or agricultural property, these can qualify for full or partial inheritance tax relief.
So if you're smart about how you invest, you might be able to protect a big chunk of your wealth from inheritance tax.
That's right. But as with any investment, you need to balance the potential tax benefits against the risks and returns of the investment itself.
So it's not just about minimizing taxes, it's about making wise investment choices that fit into your overall financial goals.
Absolutely. And speaking of financial goals, one part of inheritance tax planning that people often forget is making sure you have a will and that it's up to date.
A will? I thought that was more about deciding who gets your stuff, not about saving on taxes.
It is about that. But having a well-written will can also help make sure your estate is distributed in the most tax-efficient way. For instance, you can use your will to set up trusts or make specific bequests that take advantage of any tax reliefs that are available.
So it's not just a list of who gets what. A carefully planned will can act as a guide for minimizing inheritance tax.
Exactly. It's a powerful tool. Don't underestimate it.
I think it's pretty clear that inheritance tax planning is a complicated area with a lot of details to consider.
It definitely is. And the best approach is going to be different for each person. That's why it's crucial to get professional advice from a qualified financial advisor or solicitor.
They can help you navigate all the complexities and put together a plan that meets your specific needs.
Absolutely. And remember, inheritance tax planning isn't a one-time thing. It's an ongoing process that you should review and update as things change in your life.
So be proactive and stay informed.
Exactly. And that brings us back to the main theme of this deep dive. How important it is to stay informed and involved when it comes to managing your finances.
It's about taking control of your financial well-being, both now and in the future.
Yes, knowledge is power, and when it comes to your money, you have that power.
All right, we've covered a lot in this part of our deep dive. We've talked about strategies individuals can use for their personal finances, discussed what the autumn budget means for all of us, and gotten into the details of inheritance tax planning. But before we wrap up part 2, I want to go back to something you mentioned earlier. Getting help from professionals. What are some signs that it might be time to call in an expert?
That's a great question. There are a few things that might suggest it's time to talk to a professional. For example, if you're feeling totally lost with your finances, if you're going through a big life change like a divorce or receiving an inheritance, or even if you're just not sure what the best thing to do is, talking to a financial advisor can really help clear things up and give you peace of mind.
So it's not just about having a problem, it's also about wanting to make the most of your money and resources.
You're absolutely right. A good financial advisor can help you see opportunities you might have missed, create a solid plan, and make sure you stick to it to reach your goals.
I think a lot of people hesitate to get financial advice because they think it's only for rich people or those with really complicated situations.
That's a common myth. Financial advice is valuable for anyone, no matter how much they earn or how much money they have. In fact, getting guidance early on can help you build good habits with your money and avoid making mistakes that can be costly later.
It's like making an investment in your financial future.
Exactly. And just like any other investment, you want to be careful who you choose. Look for someone qualified and trustworthy, someone who you believe has your best interests at heart.
That's great advice. Well, I think it's time for us to wrap up part 2 of our deep dive. We've covered so much, and I really hope our listeners are feeling more confident about taking control of their finances.
I hope so too. Knowing what to do is the first step, and then taking action is the next.
We'll be back soon for the last part of our deep dive, where we'll talk about more resources and tools that can help you on your financial journey. Until then, keep learning and keep your money safe.
Absolutely. And remember, it's never too late or too early to start taking control of your finances.
That's so true. All right, we're back for the final part of our deep dive into UK tax and business updates, and I'm feeling ready to put all this knowledge to work. But before we wrap things up, I want to make sure our listeners have everything they need to keep learning and exploring. You've mentioned MA and CO accountants a bunch of times now. Are there any specific resources they offer that our listeners could check out?
Yeah, definitely. MA&CO have this really great blog. It's full of articles on all kinds of financial topics, tax updates, investment strategies, business planning, you name it. They do a good job of explaining things in a way that's easy to understand, so it's a great place to stay up to date.
Awesome. We'll be sure to put a link to their blog in the show notes. What about other resources? Any books, websites, or tools you recommend?
Oh, for sure. If you're looking to really dig deep into specific areas, there's a lot out there. For example, the government's own website, gov.uk. That's where you'll find tons of information on taxes, benefits, all that good stuff.
Yeah, gov.uk can be a bit of a labyrinth, but it's definitely the official source for anything tax-related.
Right. And for people who like learning by watching or listening, there are some great YouTube channels and podcasts that focus on explaining financial stuff. Just make sure you're choosing sources that are trustworthy and fit with your own views.
That's a great point. There's so much information out there, you really got to be careful about where you're getting it from. Now, before we sign off, I want to touch on something we talked about earlier, that feeling of being completely overwhelmed by financial decisions. It's easy to get stuck in the weeds and feel paralyzed by all the choices. What advice would you give to our listeners who might be feeling that way?
It's definitely a common feeling, and it's important to recognize that. What I would say is, try to focus on what you have control over. You can't control the global economy or what happens with interest rates, but you can control your own spending habits, your savings goals, the steps you take to plan for the future.
That's such a good reminder. It's easy to get so focused on the things we can't change that we forget about the power we have in our own lives.
Exactly. And remember, it's about making progress, not being perfect. You don't have to change everything overnight. Even small steps, if you do them consistently, can have a big impact in the long run.
So true. It's like they say, a journey of 1,000 miles starts with a single step.
Exactly. And if you ever feel lost or uncertain, don't be afraid to reach out for help. There are so many resources available, from financial advisors to friends and family who might have some good advice.
Right, you don't have to go it alone. Well, you've given our listeners so much to consider and so many resources to help them move forward. Thank you so much for sharing your expertise with us today.
My pleasure. Happy to help.
And a big thank you to all of you listening for joining us on this deep dive into the world of UK taxes and business. We hope you've learned some valuable things and that you feel empowered to make smart decisions about your financial future.
Remember, knowledge is power. And when it comes to your money, you hold that power.
So go out there, make wise choices, and may your journey with your finances be filled with success and peace of mind.
May your returns be plentiful.
That's a wrap on this deep dive. Thanks for listening, everyone.